let's just take something average. Altria is pretty average. Carvana's high implied volatility. Altria has been average. I don't know why it's up here, but let's take a look. I want to go to calculators and then Black-Scholes. This is looking at the 38 and 40 strike. We'd be selling the 40 strike put, buying the 38 in this case, and the expected prices, it's not actually accurate what we saw there. Let me go back here. What we're really seeing in Altria is 27 cents versus 5 cents roughly, 22, 25 cent minimum net credit. But the Black-Scholes calculator has this price a little higher. So let me put this up. Let me put the implied volatility up to about 0.35. I think that's where we'd get about 27 cents. 55, so that's a little bit too much. I'm sorry, let me take that back down to 25. That should be about right. All right, now what I'm doing here, you know what, let me change this. I'm sorry, I thought it would help showing the double, but it's not going to. I apologize, Chuck. Let me just keep it at 1 here. And we were at 0.25 roughly. Fantastic. All right. So here we're looking at the put bid time decay. And we see it's at 29 cents to start, 1 day in at 27, 24, and 5 days in will be about 18, not quite half. Okay? So about a third. And then the remaining 18 cents, 2/3 of that premium is expected to decay over the next 5 to 10 days. All right, so the first 5 or 6 days, going out to expiration next week, the 15th, we're at 13 cents. Okay, so maybe we've lost about half, and then we lose a little bit more. But those first 5 days, it's not really there. Oh, sorry, Chuck says, just to confirm, 14 days, 3 weeks out? No, it's 2. But I wouldn't be opening the position. If I was opening it today, you could call it 3. I'd be opening for the 22nd, Chuck, today being the 8th. Come Monday, the 11th, it's going to be for the 22nd expiration, which would be 11 days out. So 2 Fridays out from Monday as I open the position. You can call it 3 Fridays from today if you open the position today. But as I mentioned, once you get in that pattern, you're typically opening the new positions on Monday. Okay, so this would be for the 22nd. It's 14 days technically to expiration because it's not including the weekends. And it's, 14 days from the 8th, so we just have the 15th between. But if you count today, the 8th, you could say is 1 Friday, the 15th is 2 Fridays, and the 22nd is 3 Fridays. And I don't count it that way. I see it as 2 Fridays. This trading week to the 15th, this trading week to the 22nd, 2 weeks out of time. Now, let's do the same thing with the same volatility. And I'm going to use the 40 strike, but that's not probably the strike we're going to use, and we're going to take a look at that in a moment. 216, 70 days out in time, 0.25 volatility. Okay, now, put bid number 2, price at about 105. That's about 5 times the premium we're receiving for a 27-cent option. Now, a little bit less than that, probably 45 cents, or 4.5 times more, excuse me. But an expected put bid of around 105. Now, as we move forward in the first 5 days, we're seeing a price of 101. We've only lost 4 cents. And then going forward for the next 5 to 10 days, right here we're at 96 cents on the 17th. Just after the 18th, Monday following the expiration, we're at 95 cents. We've only gained 10 cents in premium. Where if it worked out the way we wanted to, it would be close to the full 27 cents decay on the short put. And then moving more forward, here we're at 92 cents. So we started at 107, we're at 92. We've made 15 cents. At expiration, we're at 91. Starting with 105. We've only decayed 14 cents of premium on the short put on the 70-day out option. In the 2-week time period, we made 27 cents on the 2-week out premium. You get that more rapid time decay close up. Now, yes, am I making a major assumption here? Of course. I'm making the major assumption on that implied volatility would stay at this 0.25 level we entered to see the premiums we wanted to. and that the stock stayed roughly at the same price. The expectation is the stock's going to move up. I'm going to realize more of this net credit in this case, and I should be good. But if it doesn't, and it stagnates, the theoretical pricing models, the expected decay of the options shows us we won't make as much selling something that's 30 days, 60 days, or 90 days out in time in the first 2 weeks than if we just sold the 2-week out option. We're going to see more of that time decay to zero from that 27 cents than we would on this static one. And that's just how the time value decay curve goes. Another illustration of this, we're going to stay with our position, our Altria group position. Let's go to our profit and loss chart very quickly, Chuck. And again, making the assumption 25-cent net credit. I'm just going to put this at 29 to make it clear. And I have to do two different things here. We have to compare it against two different spreads. So 29-cent net credit. I know this isn't the 10 delta you're looking for. It's close. My short option delta here for our Altria position is, it's 0.15, but we've got an 85% probability. Okay. Just so we're on the swearing game. So it's 0.15, 85.6% probability above. Now, what am I doing on this one? Here's our trade. Selling the December 40 put, buying the 38, a 2-point spread, even 25-cent net credit on a risk of 175 max if the stock's trading below 38, 14.3% return for 14 days or 372.4% annualized. What happens on the 21st? Our stock remains at 41.30. Implied volatility remains where it is. We're going to be near the full profit naturally. $25. Now, you saw that 70-day out series. Let's do the same thing. Okay. Let's go 49 days out. I'm sorry. The calculator lets you choose any expiration you want, even though it's not there. But we'd be selling the 40 put and buying the 38. And this almost illustrates Chuck's other point. Remember, we were getting 25-cent net credit for the 40 and 38 for 2 weeks out in time. Going 50 days out in time, 49, so almost 3.5, 4 times the amount out in time. We're not quite double. We're getting 43 cents. I'm going to take these 50s out if you don't mind. Leave that at 63. Leave this at 20. Okay, so we're going to get 43 cents of net credit. And this is a return of 27.4%, close to double. But what happens on the 21st of December, day before expiration? Stock remains at 41.30. Applied volatilities remain roughly the same. We have a profit of only $14 expected. But that illustrates the point. These are expectations. If the stock moved up to 45, this stock's not going to move it forward. But in 2 weeks, let's say we go up to 43.50 from where we are now, we'd be at a profit of maybe 38 cents on this one, closing early, theoretically, where we'd only be making that 25 cents on the 2-week out trade. But then again, I'm not looking to project where the stock's going to be. I'm looking to project where the stock isn't going to be. And in my opinion, the stock isn't going to drop below 40, 50, or to my 1% rule over the next 14 days, or 5 to 10 days as you're expecting. I'm not projecting it's going to be trading at 42, 43, 44. If I saw that gain, I might be doing something else, like buying a call, looking for a slightly at or out of the money call that might yield me a higher profit if I really feel confident in that expectation. Knowing both well and leveraged positions, I can lose 100%. But something's missing here, isn't it? As you go further out in time, even though the put's at the same strike, on the same stock, subtly different volatility, what else are we running into? I went to the stock research tool. I'm sorry. I meant to go to the option research tool. The reason why is because the delta is only 0.33. Going further out in time, as you mentioned, you can target 5 to 10 days, but beyond that, it's murky. So is the rest of the market. That's why the 40 strike, 49 days out in time, has double the delta, or only about 2/3 of the probability. We're at 68% instead of 85. Now comes a dilemma. You did say that you wanted to see maybe double the position, and we saw that if you had double the premium in this case, you still didn't make as much money. You made about half, right? We had double the premium initially for the 14-day or 14-day out trade, on the 49-day out trade. I'm sorry, 43 versus 27. But if the stock stayed the same at 41.30, expectation was we'd only make 20 or 14 cents or $14 instead of the full 27. Now, if it moves up, of course, that's a different story. That's what we were talking about. Did you have to have double the premium? That's why I said I think you needed almost 3 times. So instead of 54 cents net premium from 27, I think we need to be closer to 75. So let me put this at 85 and put this at 10. Now, I might be wrong. So there's our 75 cents. That's not quite 3 times, but it's, 2.5, 3 times. And again, the stock's trading at 41.30 on December 13th. Nope, not the 13th. I apologize, the 21st. Okay, 46 cents. So maybe that is a little bit higher. Let's try 54. Maybe your double is more accurate depending on the volatility. That does depend on the volatility and any shifts in volatility, Chuck, too. So I want an even 54 cents. We'll put this at 74. Put this at 30. No, wait. 20. I'm sorry. Friday nights, guys. I apologize. There we go. All right, so this would be 54, double the premium. Stock stays the same price for the first 14 days in the trade. Okay, and that's even. Assuming volatility remains the same, 0.1971, if it moves up, you're not going to have as strong of a liquidation value as you know. So maybe it is double, but normally what I've seen is about triple. But it also depends. We're talking 14 days versus 49. 11 days versus 70 might be more of a difference. You're not seeing as much time decay, so you might need more of the movement in the stock or closer to triple the price. I apologize. I think that's what I was thinking of in your first part of your question. All right. Now, where was I going with this idea that this delta is here? Well, if you wanted to go out 70 to 90 days out of time, we're sticking with 50 because it's there for Altria for our example, Chuck. But you wanted to keep your probability at a 10 delta. As you mentioned, you're not seeing much higher premium. We're going further out of the money. Altria, as we've seen, has a lower volatility. Let me change the expiration date to that 49 days out in time. Or January 42, I think we were looking at. Let me take this out. And let me look at MO. I'm sorry. Let's search by symbol for MO. So this is going to show me options spreads on Altria out to that January expiration. Not quite the 70 days you were talking about. Let's do the 70-day, actually. I saw that in there. Oh, it might not be there. That's why. That's why we didn't see it. Okay, I'm sorry. We're going to keep MO. Let's see if anything matches. Nothing. Okay. So let me kill the return. Let me kill the net credit. I still want an 85% probability, or I could put in the 0.10 delta. We know it matches the stock criteria. Otherwise, it wouldn't have come up in the results. Strike difference greater than equal to 2 is fine. Bid-ask spread should be fine. I'm going to take out the open interest just in case as well. Earnings is fouling me up. That's the trick. Altria probably has earnings between now and expiration of January, not our 14-day out position. Really? Okay, let's just use the option chain because turn on. That should be finding something. Finding it very hard to believe that it's not pulling anything up because the stock criteria matches. All right. It's very odd. I could take everything. I'm going to clear filters. Unless, no, it has to have a January. Short option delta. Let me use 0.15. No other criteria. There we go. To get the 0.1 delta, the short option delta around 0.1 or 0.09, I'm going to the 37.50 35 strike for a 9-cent net credit, only a 3.5% return. I know you've thought of this, but I wanted to point it out to others that might have this consideration. Your initial comments for your safety, I'm sorry, let me go back here. For your safety range was looking at a 10 delta. Okay? Expiring 3 to 10 days out. Now you're going 70 to 90 days out. When we compare the same strikes, we saw almost 2 times that premium, or close to it. We were looking at 27 cents versus, what was it, 48 or 49 cents for the further out in time series. So almost double. But this delta was at 0.33 or 68.5% probability. It's not in that 85% probability range that we'd like to see, or that 10 delta. If you go 70 to 90 days out and go to your preferred 10 delta or 15 delta or 85 or 90% probability, that's where I think you ran into the problem where you had mentioned that you weren't seeing the same premium. You were seeing almost the same initial net premium. And that's because you have to go further out of the money if you're trying to keep that delta and that probability in that case. And then again, you mentioned that you're not even at break even because you got such a small premium to begin with. So keeping the same strikes and going further out in time because your expectation is there's an 80 to 90% chance that in our position, Altria would not be going, below 40, 50, the 1% rule. It would stay above our strike price of 40 in the next 14 days. Beyond that, it got murky, as you said. Keeping the same strikes is where you get double the premium. Going further out and trying to keep that same delta and that same probability, you're going to be seeing that lower premium in most cases. There's also a shift in volatility here that we saw where the further out is lower volatility because earnings has to be coming out at some point, maybe not before January, but if we went to the further expiration, if there was a February or March, we'd probably be crossing another earnings as well. If we held it that long, which again wasn't your plan. So, real quick, let's go back real quick to sum up. And I want to use something bright. Yeah, let's do that. Okay, so sorry. Okay, this is fantastic. Your success rate is higher than mine. I'm usually at around 87 to 88%. Following basic strategy, that basic search, most of the time, that's shown on PowerOptions. Okay, and we talked about the longer term expirations needs to be at least double the premium on the shorter term options. We saw that to be true. I expected if we went 70 to 90 days out, it'd be closer to 3 times, maybe 3.5 times. But in this case, that's what you're looking for. We saw it to be about double. If you try to go that far out in time, that's 70 to 90 days, and try to keep that 10 delta or 85% probability, you're not going to be seeing 2x the premium. Okay, we're just going to review here of these kind of questions. Yeah, same strikes, not same delta is what I'm illustrating here because your expectation was in the next 2 weeks it was going to stay above that price. But we're not seeing 2 times the premium going 49, 50, 60 days out in time because the delta's lower with the expected calculations and the theoretical Greek calculation models. So the delta of 10 is much lower at 37.50. All right. So the review of these 3 points here, fantastic success rate. Then here's the observation. Most of the time, I'm not receiving much more premium than 70, 90 days to expirations, and that's because you were looking for the 0.10 delta or 90% probability rather than comparing against the same strikes. What expiration periods would you consider to be the sweet spot for credit spreads? For me, it's that 2-week out. Chuck, I've got the note here. I've got to go through the slides of the 8 or 9 different modules, and there's 3 sections in each module in that full bull put credit spread course that we're working on polishing up. So I'll try to find that one graphical comparison I have. It's just a table, of course. Excuse me, on PowerPoint. Shows the comparison there of 1 week out, 2 week out, and I think 3 week out and monthly of just returns following the general criteria and not management, not using management, just what happened without the management in those trades. Okay. And because we mentioned again, you don't need to worry. We're using the same strikes here because if my delta 14, 15 days out is 0.10 or 90% probability, 85, 90% probability, but I'm planning on closing it in 5 to 10 days, that's still the strike price I'm focusing on. Again, as you said, same strikes, not same delta, because you're not going to get double that premium. And even with double the premium, we saw that we were close, but with the actual premium that was there, if we didn't get double, when we looked at that 49-day out, in 14 days, expected return, expected gain was only 14 cents, assuming the stock stayed the same price and volatility remained the same, where we would have made almost double, 27 cents, with just the 2 week out because of the time decay factor.